While we are familiar with the concept of income tax, some of us must be knowing that the major part of this standard is in accounting for income tax, especially deferred tax. Right? Because per se income tax is a tax on income as per tax law of the country, and therefore tax as per tax law of the country is recorded in SOPL below the profit before tax, and it's called as current tax. Right? It's called as current tax. So the current tax is tax as per tax law of the country. On the other hand, there is something required for income tax purpose, no, for the accounting purpose is deferred tax. The reason being, the accounting profits and tax profits can be different, will be different. And this is due to the base of accrual and matching concept. Interestingly, the differences can be temporary or permanent, but the permanent word is not there in IFRS as well as in DAS. So the temporary differences are not temporary differences or other than temporary differences. The temporary differences can be deductible temporary differences or taxable temporary differences. So something which results into the extra accounting profit is a taxable temporary difference, and something which results into reduction in the accounting profits is a deductible temporary difference. In what respect IFRS differs as far as the tax standard is concerned? In the legacy standard, there were timing differences. Now we call about temporary differences. Similarly, the IFRS follows balance sheet approach method as against income statement approach. Right? All right. Also, as the IFRS gives thrust on consolidations, it obviously puts a condition that deferred tax should be recalculated at the consolidated level. So one of the common adjustment which comes is unrealized profits on inventory, where that needs to be eliminated and one needs to create a deferred tax on that. Similarly, whenever the associate is consolidated, the deferred tax is created on undistributed reserves. Of course, the exception is if there is a control and timing of reversal of this difference. It means the control and dividend policy, or it will not reverse it in the foreseeable future. Then one can take that into consideration. Indexation benefits on land. Somebody follows the revaluation method of land, or somebody follows a cost model, but the Income Tax Act allows the indexation benefit. Then obviously, on the sale date, the profit will be very less. It's a question whether on the annual basis one should create the indexation impact, calculate the deferred tax asset. Because as compared to had the tax liability been crystallized, the situation would have been different. Currently, if there is a revaluation method for land, then one creates a deferred tax liability. On the other hand, if there is an indexation, should we create a deferred tax asset? Reassessment on every reporting date of the deferred tax asset and liability is required, and deferred tax asset as well as liability is always to be classified as non-current. And there should not be any discounting. Discounting concept is very common. Whether it is a contingently payable consideration in future, or if there is a payment to be done beyond 12 months, or recognizing the trade receivables which are having a credit period of more than 12 months, the present values are recorded as asset or liability. But when it comes to deferred tax, there is an exception that there is no discounting done. Let us learn the concept called CV and TB. Okay, these are our created short forms. But CV means carrying value as is shown under IFRS, whereas TB is a tax base. Okay, let me put that word. Tax base. Yeah. If you create a balance sheet as per tax law, what could be the tax base? Then goodwill. Goodwill is a balancing figure. So therefore, goodwill on acquisition, one does not create deferred tax. Similarly, at a later date, when one does impairment of goodwill in the consolidation, there also no impact is given, no deferred tax, because that will only increase the goodwill. However, items under OCI and items under SOCIE, there is a deferred tax to be calculated. For example, revaluation reserve is created in OCI. So the deferred tax impact is given for that. If the profits are probable, then deferred tax asset can be created. Is the tax jurisdiction same? Does the tax law allow set up within group companies? Is there a double taxation avoidance agreement? All these factors need to be studied while doing the consolidated accounts for an MNC. As regards whether the one company in loss and another company in profit and if they are consolidated. Here is a working of examples which are other than temporary, created as per Indian tax laws for the benefit of the people. What are the items which are disallowed under Income Tax Act? Penalties, cash payment above certain limit, or expenses in relation with exempt income, or disallowed personal expenses, donations 50%, CSR expenses, preliminary expenses. All these expenses are charged in the accounting P&L many times, but are not allowed under Income Tax Act. Therefore, the profit as per tax law goes up to that extent. And hence, the profit as per account is a different figure and therefore is a lower figure. And hence, the one will feel that we should create some deferred tax on this, but it is not a temporary difference. It is not a temporary difference. Therefore, no deferred tax to be created. Similarly, exempt income, dividend, agriculture income, long-term capital gains. Classic example of long-term capital gains one can get in agriculture. ITC's balance sheet. One can see ITC's balance sheet. Similarly, in some cases, for encouragement to set up the unit in backward areas or carry out the scientific research or hire new employees, encouragement of employment generation, or reimbursement of local employees' salaries tax-free. These are all the areas where weighted deduction was allowed. And hence, these are also the temporary differences where deferred tax calculation is not required. Here is a format which I am giving you for everybody to create the calculation of deferred tax. First column, the value of asset, the name of asset or liability, the carrying value, the tax base, the difference between the two, then whether it is temporary, yes or no, then closing deferred tax liability, opening deferred tax liability. The difference is deferred tax expense or deferred tax income or credit, and to be put to P&L or OCI. So you can see here only revaluation reserve related deferred tax expense is creating an additional liability and it is put into OCI. Whereas the other cases where there is a depreciation amount difference, maybe due to the percentage difference in the PP or intangibles which are allowed as an expense but are capitalized in the books, or unrealized profit on inventory, or loans at effective interest rate. These are all the varieties where IFRS accounting is mainly different and therefore gives rise to temporary difference. What is that we should remember? Carrying value concept and tax base concept. Next thing we should know is we should always show DTL at net. Then DTL is always a non-current. Because the classification is very different. So the standard says keep them in non-current. Then goodwill and its impairment, they will not have any deferred tax. Then associate and JV, We are required to do equity accounting, and therefore the undistributed profits come into the consolidation books, and therefore deferred tax on undistributed profit should be calculated on consolidation. So separate accounts, if they are maintained on the cost model, then we will end up into cost model treating on only dividend received will come into the P&L. Whereas in equity account, if we choose to have an equity account, the separate statement, that choice is available under IFRS, then that will give rise to the deferred tax. And if we don't do that in the separate financial statements, then in consolidation again the deferred tax will come because the equity accounting is compulsory. Unabsorbed losses, they go by the probable concern. Instead of virtually certain, the probability decides whether the unabsorbed losses should be created on deferred tax or not. And there is no discounting. I repeat, there is no discounting for deferred tax liability and asset. Right? So appears to be an easy standard, but wording can make it complex because it's a balance sheet approach. So one should understand the difference properly and arrive at what is going to be the exact impact. So there are tricky examples which are asked. I discuss some of the questions of the nature where the language can become a pain. So let's say carrying value versus tax base. For a particular PPE standard, is more by say 8,000. So what are the possibilities? The opening balance is same, or there could be a difference. Then there could be a purchases which has to be same, but depreciation can be different methods, and we might be following the revaluation reserve for carrying value purpose. So this and this can give rise to the difference for the year. And then there will be a cumulative impact of this plus this plus this. And on this, we will arrive at the percentage and find out the closing tax liability, closing DTL, and deduct from that opening DTL, which will help us to get for the year impact, of which revaluation related will go into OCI and depreciation related will go into P&L. I'm giving everybody 5 minutes to basically understand and ask if there are any questions. Right? All right. So Lalit Ajmera, you want to hear a numeric example. All right. Then illustration side one more time. All right. So let me give a numerical example. A sells to B. A holding company sells to subsidiary material worth $5,000. 40% of that is in inventory at year end, and margin of holding company is 20%. How much a deferred tax? Calculate and tell me. Yes, I hope you are answering. 120. All right. Deferred tax asset or deferred tax liability? DTA or DTL? You need to know the tax rate also. So let me take a tax rate of 30%. Now you answer. Anybody would like to answer? I wonder how did you answer without having a tax rate? No assumption in deep IFRS exam. No assumptions. In deep IFRS exam. One of my bosses used to tell me, assumption means making an ass of you and me. So anyway, you're done with 30%. Let's see now how we can calculate. So in the asset or liability, what is the name of the asset I should put? Inventory. What is the carrying value? Carrying value is always of subsidiary in this case, and that will amount to 5,000 into 40%. That means 2,000. But since there is a margin involved of 20%, sorry, this will be for tax base because subsidiary will file its own returns. And the carrying value will be less than that. How much will be less? So it will be 1,600 because the margin is 20%. All right. So therefore, there is a difference of 400 and carrying value is lower. So it gives rise to deferred tax asset. Is it a temporary? Yes. And at 30% rate, the DTL will be 120. Deferred tax asset creation. So the credit in the P&L. So let us give a big clap to deferred tax asset, Lalit, deferred tax asset. Amit Singh, figure is right. And who else has replied? Lalit has replied the figure, that is correct. All right. Is that a numerical example clear? Let's take another example. Research and development expenditure charged or incurred was 900, of which 500 was capitalized in books. As intangibles. on 1st October, year April to March. Life of intangible asset, 5 years. If tax rate, 30%. But all 900 were allowed as tax deductible expense. Find out deferred tax asset or liability. Find out deferred tax asset or liability. $135 DTL. All right. So the asset or liability is intangible asset being development expenditure Carrying value is 500. Tax base is 0. So the difference is 500. Carrying value is higher. Temporary, is it temporary difference? Yes. Deferred tax liability because 30% tax to 150. Oh, I'm sorry. We need to consider depreciation for 6 months. So the 500 actually becomes now 500 divided by 5 into 1 by 2. 50. So we are at 450. 0. 450. Yes. 135 DTL. Has everybody understood? Very correct answer by Amit Singh and Lalit Ajmera. Lalit Ajmera, no, Lalit Ajmera, you said 150. Lalit, not correct. Shirish, correct. All right, Lalit. So we understood. Let's go to the next example. Next example is rent paid as advance, allowed as expense under income tax. While accounting done next year. 1200. Tax rate 30%. Paid on 31st March. Yes, please answer. Shirish is saying 360 DTL. Let's wait for others. Right. Anybody else? Himmat is replying 360. Amit is replying 360. Let's calculate the asset or liability, we are saying that we have a carrying value and tax base. When we pass an entry of advance rent payable, we say advance rent debit. Advance rent debit to bank. So if the balance sheet is prepared as per income tax law allows is that expense and income tax law says rent debit to bank. So the tax base asset is 0, but carrying value based asset is 1200. So carrying value is more than tax base, the difference is 1200. And DTL, because asset is higher, so 30% DTL. Your answer is correct. Let's go to next numerical question. Loan of 50 million taken. Stamp duty 1 million. 31st March. Interest rate 10%. Payable annually. Sorry, this is on 1st April. Payable annually. So this is on 31st March. Stamp duty is charged to P&L. Calculate deferred tax. Asset or liability. I'm awaiting your answers. Tax rate 30% again. All right. So this is an asset or liability? Liability. How much? Which is the name of liability? Loan. Carrying value of liability as per the books 49, because stamp duty is to be deducted. Tax base, however, is 50. So therefore the difference is 1 million. Now here the liabilities case, TV is lower than TB. So again DTL. By 1 million into 30%, 0.3 million DTL. Is that clear? Is that clear? Please answer whether this is clear or not. Then only we can go ahead. Himmat, Shailesh, Amit. Please answer whether it is clear or not. Correct. This is liability. So detailed. Clear. All right. Let's go to next point. Next point is property, plant, equipment. Carrying value was 50 million and tax base was 45 million. Opening CV was more than TB by 1 million. Revaluation reserve during the year was 3 million. 30% tax. No past revaluations. Right. So let's take a 15 minutes break. And when you come back, start answering.